Hello traders, welcome back to our channel. In this video we are going to share the top price action patterns that every trader should know. In simple terms, price action is a trading technique that allows a trader to read the market and make subjective trading decisions based on the recent and actual price movements. Price action is often subjective, and traders may interpret the same chart or price history differently, leading to different decisions. Another limitation is that past price action is not always a valid predictor of future outcomes. The most important thing that you must learn and know is to identify the trend and the structure of it. As we know, there are three types of trend: bullish, bearish, sideways. It's essential to define it before considering any trade. This must be part of your trading plan. The components of a downtrend are lower highs and lower lows. It indicates strong selling pressure, and the number of sellers is greater than the number of buyers. A lot of traders are selling the currency, which results in a downward movement of price with time. In this chart we have a clear downtrend. We are going to teach you how to define it. First of all, with a line tool we mark the price impulse. In this way you can visualize better the structure of the trend. Based on the structure you should highlight the lower highs and lower lows. New lower low is created when price breaks below the previous lower low. As simple as that. We must plan trades to be as close as the lower high level in order to enter with the trade at favorable prices. The trend inside the correction leg in counter trend of our major trend. We have a bearish major trend and bullish trend at the correction leg. When we shift on lower time frame we can define it more correctly. We shifted from 1 hour to 15 minutes time frame. Once again with a line tool, we are going to mark the swing and correction waves of the price. We have here the higher highs and higher lows, which mean the high and low of the recent candlestick is higher than the high and low of the previous candlestick consecutively. It represents that market is in a bullish trend and buyers are controlling the market. And then we have the trend change pattern, another fundamental pattern in price action methodology that you must acquire. The trend has a high probability to change when the price breaks below the higher low. To enter a reversal trade in this situation, we must wait for the pullback that usually happens at supply zones. In a nutshell, this is the market structure that everyone must take in consideration before entering and exiting any trade. Next powerful price action pattern is the double bottom or double top. We can find them on the top of the trending market as well as in middle of the trend. The first one represents a reversal type of trade, and the second one is the continuation pattern. The classic entry is at break of neckline, but my suggestion is to adopt a market situation and be more flexible with the entry, because the market is not perfect like a textbook pattern that we usually learn in the beginning of our trading journey. Recommended broker is Longhorn FX. Trade a wide variety of assets with leverage up to 1 to 500. Check the link on the description to find more. On this chart we have a double top pattern with fake out on right top. Usually this type of double top with a fake out is more accurate and significant than a classic one. The classic target measurement is the distance between neckline and the top, but as we said about the entry, we should learn to see trading outside the box and textbook examples. The target of this current pattern is going to be the fresh demand zone or the support level above it. It's recommended to enter a sell trade on the fake out event after the close of next candle. In this example, waiting for break of neckline doesn't offer a good risk-reward trade. The RSI divergence is another confirmation that we can use when we trade this type of formation. As we previously mentioned, the second type of double top pattern, it's the continuation one. It's not located on the top of the market but in the middle of it. The price formation and the risk reward allow us to enter at break of neckline. Regarding to the target, it's recommended to choose the next sensitive zone like we did on previous example. We have a fresh demand zone that we are going to use as price target. We have also hidden RSI divergence confirmation. We shift to another double top example and apply the same steps. We highlighted the tops and the neckline, divergence confirmation on the RSI indicator, and the fresh demand zone as a target. We can enter at break of neckline or after the candle confirmation on the right top. We are defining the structure with a line tool. We have clear downtrend structure with 2 lower lows and 2 lower highs. Even if we missed the entry on the top, we still can join the bearish move after the second lower high establishes and have candle rejection confirmation. Regarding to the target, we can use the second order block that is located below the first one. You can manage the trade by shifting the stop loss to break even when price reaches the first demand zone. BitGet is the world's largest crypto copy trading platform, official partner of Juventus Football Club. They have an exclusive welcome bonus for our channel. Sign up with the link to earn 3,000 USDT in rewards. We have here a double bottom pattern. The right bottom has made a fake out like the first example that we break down. We had a RSI divergence too. We are highlighting the neckline and we are going to study the structure. As we can see, price did not make a simple pullback, but a complex one. The complex pullback happens very often and are very profitable, more than simple pullback. The complex pullback is the same thing as an ABCD pattern. This will help you to calculate the ending point of the pullback in advance. The last price action pattern is supply and demand zone. Now you are familiarizing a lot with them. We use almost every time because are very effective. On a bullish trend is recommended to trade the demand zones. On the chart we have defined 2 demand zones. The minimum target will be the last high, entry at the edge of the zone and stop loss below the zone. In a nutshell, this is the correct way to trade them. The risk reward can vary from the size of the zone and distance between the edge of the zone and the last high. As you can see on the chart, the 3 demand zones has different risk rewards ratio. And our decision to enter a trade or no depends from this specific. Entering against the trend is not a good idea. As we can see, this supply zone failed to reach the target and price broke above it. Thanks for watching the video till the end. See you to the next one.